You ready to like really understand futures and options?
Yeah, we're gonna make it easy to understand.
Because, people talk about this stuff all the time, and it
Yeah,
can get confusing.
it really can.
We did all the research, so
Yeah.
you don't have to. Futures and
A
options.
deep dive,
A
yeah.
deep dive. Futures and options. Um, so I guess to get started, uh, we probably should say what they are.
Yeah. They're both types of derivatives, right? So they get their value from some underlying asset.
So that could be like a stock or,
Exactly. Yeah. So you could have like a stock, you could have, commodities, barrels of oil, gold,
yeah, gold. Yeah.
all sorts of different, wheat, corn, all that kind of stuff. Or it could even be, a whole basket of something. So like an index fund or something like that.
So like the S&P 500.
Exactly. Yeah.
Okay, so then why would someone want to use these things?
Yeah, that's a great question. I think the big reason is that, you're not actually owning the asset itself, right? So you're kind of getting exposure to price movements without actually owning the thing.
Okay.
And that can be useful for a couple different reasons. So one is hedging, which is just trying to manage risk.
Okay.
And the other is speculation, which is trying to, make some money off of price swings.
Okay, yeah. So if you're like a farmer and you're worried that the price of corn is going to drop before you can harvest your crop, you can lock in a price today to sell it at a future date.
Exactly, exactly. And that's a perfect example of using a futures contract to hedge, right? You're just trying to manage your risk. Um, but it's important to note that a futures contract, it's a binding agreement, right?
Okay, so I'm really locked in.
You are.
Yeah.
And, if the price of corn, let's say, went up instead of down,
Yeah.
you're still obligated to sell at that lower price that you locked in.
Okay, so there's risk on both sides.
Absolutely, yeah. It's a two-way street.
There's an example in the research we were looking at that I think drives this home. Is it imagine that you're agreeing to buy 100 barrels of oil at $70 a barrel in 3 months.
Oh.
If the price of oil shoots up to $80 a barrel, when that date comes, you are still locked in to buy at $70.
Wow, that's a big difference.
Yeah.
And on the flip side of that, right? If the price of oil plummets down to $60 a barrel,
Yeah.
the seller is still obligated to sell it to you at 70.
Okay. Wow, that's really risky. So that obligation is key to understanding futures.
It is.
Okay. So futures contracts, they're all about certainty,
Right.
right? But what if I want more flexibility?
Well, then you're looking at an options contract.
Okay, so that's where options come in.
Right, yeah. So options are basically just contracts that give you the right, but not the obligation to buy or sell an asset at a certain price
Right.
by a certain date. It's almost like an insurance policy,
Like
right?
insurance policy.
You're kind of paying a premium to have this option to act if things, go your way or not.
I see.
So, yeah.
So with insurance, you pay a premium, and that gives you...
That's right, yeah. So you pay a premium for an option, and that gives you the right to either buy or sell that underlying asset.
Okay, so then there are two different types of options.
Here are, yeah.
Calls and puts.
Calls and puts, exactly.
Yeah.
So a call option gives you the right to buy
Right.
at a certain price,
Okay,
and a put option gives you the right to sell at a certain price.
got it. Okay, so give me an example of like when I might want to use a call option.
Yeah, so let's say you think the price of Apple stock is going to go up.
Okay.
You could buy a call option for, let's say $150 a share.
Mhm.
And if the price goes up to, $170,
Right.
you can exercise your option, buy it at $150, and then immediately sell it at $170
Yep.
and make a profit.
Okay.
So that's kind of how it works.
So then what about a put option? You're essentially betting that the price is going to go down.
Yeah, so that's where, you're betting that the price is going to go down. And a good example of that would be if you already own some Apple stock
Okay.
and you're worried that the price is going to go down, you can buy a put option that will give you the right to sell your shares
Right.
at a certain price, even if the market price falls below that.
So it's like a safety net.
Exactly.
Yeah.
Okay.
But I don't actually have to buy or sell the asset, right? I could just...
That's right. You can let the option expire and just be out the premium that you paid.
Okay.
But that limits your downside risk.
Okay, so that's a key difference between futures and options.
Exactly.
Is that with futures, both parties are kind of locked in.
They are.
But with
A
options,
buyer has more control.
yeah, the buyer has more flexibility.
Mm-hmm.
But what about risk? You mentioned that options are really good for speculation, but it seemed like futures had the potential for like way bigger wins.
Right, yeah.
And way bigger losses.
because of that obligation component, right?
Mm.
So with futures, both parties are exposed to potential gains and losses based on, how much the market moves.
Right.
Whereas options, the buyer's risk is limited to the premium that they paid.
Right.
But the seller or the writer of the option, they're taking on more potential risk.
Okay. So businesses, they use futures to hedge against volatile prices.
Exactly.
And options are popular for speculation, but could you use options for hedging as well?
You absolutely can. Yeah. So, for example, if you own some stock and you're worried about the price going down,
Hmm.
you could buy a put option as kind of insurance against that.
Oh, okay. Wow. So for our listener, just remember,
Yeah.
with futures and options, understanding the details is really important before you jump in and
Hmm.
start trading.
Yeah.
Futures contracts are binding agreements
Hmm.
with unlimited risk,
Right.
whereas options give you more flexibility
Hmm.
but limited profit potential.
For the buyer, yeah.
Yeah. So it's something to think about given the current economic climate,
It is, yeah.
you know, which would be more relevant for you if you were trying to manage risk in your own portfolio.
That's a great question to consider.
Yeah. Well, we covered a lot today, but there's always more to learn. So keep learning, and we'll catch you on our next deep dive.
Sounds good.